Hey guys, this is VJR John here with your latest ConCap quarterly. It's one of the only videos that we share publicly, and we'll release about maybe 2 to 10 of these in a year. But we also send out timely market updates, which is during fast market conditions. Those updates are available for free and only for our email subscribers. So if you want to join us there and get those updates, go to ConCap Advisory and sign up for our email list. Alternatively, if you want to know exactly what to do in your portfolios, you need to be a client at ConCap Advisory. Let's start with the legal stuff. This commentary is for educational and for informational purposes only and should not be construed as investment advice or recommendation to buy or sell any security. Information presented today is as of the date of publication and is subject to change without notice. As always, we start with our macro lens, which is an analysis of the global economy and financial markets. And then we'll shift into the Beyond Money segment where we kind of explore themes of financial freedom, financial literacy, conscious capital, things like that. So diving into our macro lens, I want to start out with the beginning of the year. We had a major risk of Liberation Day, those big tariffs that President Trump was pounding his fist on the table with. He started actually the first term just the same way. Only at that time it was just China, and now it's towards the whole world. The whole world is taking advantage of us. The whole world is being unfair with us, blah, blah, blah. And we knew that the tariffs were going to come out, but we didn't know exactly how bad they were going to be. But it turned out when he pulled out that silly card in Liberation Day, the tariffs were much worse than expected. The rates were much higher than expected. Frankly, they didn't even make that much sense, to be honest. The S&P dropped about 20% in about a month and a half. The NASDAQ was close to 30%. Now, thankfully, at ConCap, we managed your portfolios pretty well. And I think probably most of you saw something in the small single digits in terms of exposure to that kind of a sell-off, which is fantastic. I mean, this is what, I work so hard for, constantly trying to deliver less volatility drag, hopefully better defense during bad times, hopefully better offense during good times. And I'm really glad that we did that. I don't know if I can do that every single time, but I will certainly try to do that. And I'm really grateful that we were able to navigate that successfully. But within about a month and a half after Liberation Day, just like that, President Trump backed off. And the tariffs ended up being much smaller than expected. And the question, of course, is why the pivot? And in hindsight, it looks like we know what the answer is. And the answer is that the bond market pushed back. And now, if you recall, back in February, we had another update that we put out. We had talked about the risk of the bond market saying no, and that's exactly what happened. So the global bond market, it's not something that most people really know about, but it is a massive, massive market. It's 145 trillion with a T. Okay, that's how big the bond market is. And you have the big ugly bill that he's trying to pass. It's 4.5 trillion in tax cuts to the wealthy and big corporations. Right, government revenues are going to drop sharply, and when revenue drops, they're going to have to finance it because they don't have that kind of revenue coming in. These tax cuts, because a lot of things are you can't cut. Social Security you can't cut, Medicare you can't cut, defense spending you really can't cut that much. If you cut revenue, they're going to have to issue more debt. The U.S. government will have to issue more debt. And of course, especially global bondholders are asking the question, is U.S. debt worth the risk at these rates? And their answer was, according to Liberation Day, it was a resounding no. If you just look at what happened to treasuries during that time, normally they're the safe haven. This time they were hit along with the stock market. And I think the underlying assumption was it was a possibility that the sovereign debt holders would dump treasuries on our public markets. And so all of a sudden now the long bond, the long-term treasury, 20-year plus duration treasury, which is a safe haven, is a possible risk asset. And that's really very, very different from what normally happens in the past. And, to his credit, now, I'm going to say something that I really don't like saying, and it's not something that I take pleasure in saying, but I got to give him credit for a change. I don't like the man. I think it's pretty clear in some of my earlier videos. I don't like him. I don't like the policies that he's putting in place. I think it overall will be bad for America in the longer term. But in this specific instance, I'm sure Treasury Secretary Scott Bessent, who's one of the more capable people on his administration, pulled him aside and said, Mr. President, this is not going to end well. You got to pull back. And to his credit, President Trump, he listened to Scott Bessent and he changed course. Market stabilized. And if you just look at the shift after that, the policy shift went from Liberation Day to let's pass a big, beautiful bill, or as what I like to call it more appropriately, the big, ugly bill. And markets have kind of climbed steadily since then. So if you look at the 20-day moving average on the S&P, the S&P's kind of bounced on that 20-day moving average the entire time. Now, I'll take a moment to kind of reflect on something deeper that may have happened here, and that perhaps many people don't want to admit to themselves. But what this whole thing revealed to me, at least, is that the United States was the sole dominant superpower in the world for a long time, especially after the Soviet Union fell in the 90s, early 1990s. It was a sole geopolitical power. And I think the case for that is no longer true. So we're still a great power. There's no doubt about that. U.S. is a major market, huge economy. Some of the best and brightest companies and best and brightest people come here. But the U.S. is no longer the sole superpower anymore. And if you just want to, you just bear out the numbers. Go to Yahoo Finance and look it up. The S&P is up year to date roughly around 15%. At the same time, Germany is up 21%. France is up 18%. China's up 24%. Canada's 25%. Mexico's 38% up year to date. I mean, I could keep going, but it's a similar theme. Many other markets have outperformed the U.S., and those markets have been the ones that have been tariffed most heavily by Liberation Day. And to me, that says a lot. And what it says to me is that the long bond, the long duration treasuries may not be the safe asset anymore if America is no longer that sole superpower. And the question, I think, is, what is a safe haven and what is it that we want to play defense with going forward? And the answer is not one that I particularly like because I'm not a gold bug, but gold held up really well during this entire time. Treasuries did not hold up as well. And so you might have noticed that we added some gold exposure to your portfolios, not to chase any trends or anything, but really to protect value, because I look at it as like a longer term defensive play. If long dated treasuries are no longer the safe haven they were, and they're kind of a melting ice cube, especially with the fiscal policy that we have in mind, I just don't want us holding the bag. And, we want to play real defense at that point. The treasuries won't be serving their purpose. Now, this is not even close. We're not even discussing valuations. I've been pounding the table for some time now. Markets are overvalued on any metric, on so many metrics. Markets are overvalued. Inflation adjusted earnings, price earnings, the average is 15. I think we're at 40. Forward PE, which is current earnings adjusted for price earnings or whatever, that average is 15. It's at 22. There's so many other metrics I've talked about in previous videos: the Buffett indicator, the yield curve inversion, price to sales. And my thought was, hey, listen, with these kind of metrics, no one would keep buying at these levels. And clearly I was wrong, because what I was not looking at, which I will be looking at going forward, is liquidity. Liquidity. If you have fiscal dominance and you have easy monetary policy, unfortunately, this party is going to keep going. Now, it's not going to go forever. I think if the bar closes at 2 a.m, I'd say we're at midnight. So it's coming towards the end. We're late cycle for sure, but it could continue to keep going. And so do I expect the market to crash tomorrow? No, I don't expect it to crash tomorrow. I think a drop is likely somewhere in the near future. But, as an advisor, you learn a lot of stuff. Markets are really incredible teaching tools. And if I've learned anything in this cycle, is that watch the liquidity tide. So now that I'm watching the liquidity tide, I think I'm going to be better able to manage risk in your portfolios when the time comes. And, the other thing that I've learned, guys, is there's no perfect way to predict the market. We could melt up. It seems like that's what everything's heading towards. Crypto is going crazy. There's nothing behind crypto, but it's going crazy. It's a proxy for risk tolerance in the markets. You have all these crazy levels of, it's just absurd. The zero dated options. Options are meant to hedge for a black swan event. Right now we have 50% of volume traded on the options market last for one day. It's just absurd. This is like casino gambling levels of risk taking in the market these days. But we're probably going to have a melt up. It looks like we're going to have a melt up, especially if Treasury Secretary Scott Bessent is right. If they pursue structural regime change at the Fed, which is what they're doing. This is unprecedented, guys. Unprecedented. The president asking a sitting chair of the Federal Reserve, which is supposed to be an independent body, to step down, trying to play musical chairs with the governors on the Fed because he wants lower interest rates, right? If this is really what's happening, if we're looking at structural regime change at the Fed, then we're looking at a melt up in risk assets. And there's no rule that says that if we melt up, that we have to crash as well. It could crash, and it's very likely. I'm not expecting the crash not to happen. It's probably going to happen, but there's no rule saying that it could go melt up. And I mean, guys, it could just stay there. It could just stay there for 20 years, and just not go anywhere. But ultimately, guys, you guys have given me a job, and that is to either retire early or on time, and two, to retire comfortably. And so even in this environment, as crazy as the valuations are, we still have to play offense, right? I mean, just a quick hockey analogy, in the 90s and the 2000s, growing up watching hockey, of course, who does not like goal scorers, right? Mike Modano and Brett Hull and Pavel Datsyuk, Mario Lemieux, right? These are tremendous goal scorers, but who's my favorite player of all time, right? It's Dominik Hasek. He's a goaltender. And, even in my investing philosophy, I have been defense first, but right now we got to think a little bit like a goal scorer. And so I'm starting to shift out a little bit out of my comfort zone. Hopefully it's making me a better investor, because what we're facing here, or what we're risking here, is what we may call right tail risk. In other words, the market melts up and we don't participate in that. And if it just goes nowhere for 20 years, then we may not get that opportunity. So I'm just hoping that, as by shifting my trajectory a little bit, that I'm a better investor for you guys, and we can help you retire early or on time and comfortably. Now, one more thing I want to add, which we haven't really talked about so far, is that this AI trade is real. Because all you got to do is go to ChatGPT, go to Copilot, and just play around with it. It's an amazing, amazing, amazing tool. And if the difference this time, we always say, oh, this time it's not different. This time it's not different. The thing that's different about this time is that the AI technology is actually going to replace people. There was the argument even back in the internet. The internet was like, oh, well, you know what? This is going to replace jobs. The problem back then with the internet, that theory was that it did replace jobs, but it also created an entire industry of jobs as well. That was the difference in the internet. The difference here, guys, is that AI is actually going to replace people, like for good. There may be more jobs created. There's no doubt about it. There will be definitely jobs created. In fact, if you guys have an opportunity and you're looking for a promotion in your current workplace or whatever, look into AI. Look at how AI can augment company productivity or cost measures and things like that. It is an amazing tool, and it's a really, really good skill set to have if you haven't really explored that. But it is actually going to displace a lot more jobs than it will create. And so we could be looking at a very, very strange environment, and where the stock market is trading at, I mean, if you're talking about 22 times earnings now, it could be trading at 30 or 40 times earnings in the future. If they're really, I mean, you could be looking at a great stock market and a really terrible economy at the same time. Never happened before that I know of. I mean, it's never ever happened. And usually the real economy, the stock market follows the real economy eventually. But this is a little different. And all you got to do is look at layoffs, guys. It's starting up. And to be honest, this may be just the first round. I mean, who knows? Maybe this is just the first round. Amazon, UPS, Target, these just major, major companies. I think the tally of just those three companies alone is like 60,000, 65,000 jobs are going to be cut, just those three alone. And this is just round one. I think a Stanford study came out recently. There was a 13% drop in employment for people in the 22 to 25 year bracket. So new college grads, a 13% drop in AI exposed roles. That's millions of people who are not going to be able to find a job. This AI trade is real. I really feel like we're at the beginning of it. We have increased exposure to your portfolios in these stocks, in the sector. So it is very possible that this thing melts up, is what I'm trying to say. The other thing that I want to mention is that, when you have higher unemployment and you have young people who are unemployed, oftentimes that leads to civil unrest. And that's where safe havens matter. This is where I'm kind of connecting the dots here. Gold is likely to rise longer term over long bonds, over the long duration bonds, especially if we continue to pursue the big ugly bill, and it's just going to exacerbate inequality. It's going to mean that we fired the printing presses. Guys, inflation hasn't gone down, as much as he's promised. Inflation is still there. Gas prices have come down somewhat, but pretty much everything else for the average person, people are still struggling. And so we may be looking at some extraordinary measures here. And so going back to the safe haven, gold may really be coming in handy. That's our macro lens outlook. I want to pivot now to something that has been really on my mind for some time, which is our Beyond Money segment. The title of this Beyond Money segment is The Big Ugly Bill, a Mirror, Not a Miracle. So I want to slow down for a moment and take a breath. I really want to take a look at what the big, beautiful bill is all about. On the surface, sweeping piece of legislation, bold tax cuts, deregulation, promise that if we just give to the wealthiest Americans, corporations, we'll have more room to grow. We're going to grow ourselves out of the economy. The benefits are going to trickle down to everybody else. The working class, middle class, everybody's going to benefit. Jobs, innovation, prosperity, unicorns, rainbows. Woohoo. It's a familiar story and one we've seen before, one we've heard before. But there is no data-driven precedent for that actually happening. Okay? The numbers are quite different. The architects of the bill, they promise growth. Long-term projections tell a very different story. According to independent economists, not just one, many independent economists, budget analysts, the big ugly bill is expected to shrink GDP by nearly 3% over the next 3 decades. Okay, that's not a technicality. That's a slow erosion of opportunity, wages, public investment over time. The national debt at the same time is expected to balloon. By 2030, the national debt, the U.S. Debt to GDP ratio is going to be around the likes of Greece and Italy. Now, you guys remember Greece and Italy had a major sovereign fiscal crisis back in the 2012, 2013, 2011. I can't remember exactly when it was. But these are the kind of levels that the debt to GDP might go to here in the United States. It's not just a fiscal concern. It's not just a fiscal, because they argue, oh, we'll grow our way out of it. The problem is that we can grow our way out of it, but where are those gains going? If it's going to just a few people while everybody else struggles and suffers, overall, longer term, this economy is going to work less and less better for everybody else. And states are feeling it, guys. States are feeling the pinch. When you cut off funding, right? I mean, we have this unbelievable policy where they're cutting Medicaid for people at the bottom tier. I mean, 900 million, I can't remember exactly what the number is, but $900 billion in Medicaid is going to be cut. So we're going to have 16 to 19 million Americans who can no longer afford healthcare. I mean, they're not going to be able to get healthcare. Somewhere along the lines of 40 or 50,000 people are going to die a year because they can't get health insurance or they can't afford their medical bills. Guys, this is bad for America. I mean, it may be good for the 1%. Us investors, we're probably going to be okay, but this is bad for America. And, I think this is really what I want to talk about. The lion's share of these tax cuts go to the top 1% corporations, okay? For everybody else, the benefits are almost zero, okay? I mean, and we're talking 1,000 here or 2,000 there. It's almost zero. How is that going to help the average person with the weight of inflation? How is this going to benefit people, right? This idea that it will trickle down, it's been tested. It doesn't work, right? There was a 2020 study done, looked at 18 countries over 50 years. Tax cuts for the rich consistently increase inequity and they lower employment and economic growth. It doesn't fall down. It doesn't trickle down, guys. It just stays up there, okay? There's this argument that I hear quite a bit. Oh, we got to make America great again. We got to go back to the 50s, 40s, 50s, 60s. That was the time when things were great. Let's go back to the 40s, 50s, and 60s. What was the top marginal tax rate on the wealthiest Americans? 70 to 94%. Look it up. That's not a typo. Look it up. 70 to 94%. That was the top marginal tax rate. Okay, today it's about 37. So during those decades, when America was great, apparently, the greatest it's ever been, those decades saw some of the greatest, strongest economic growth in U.S. history. The middle class expanded, infrastructure boomed, college became more affordable, home ownership soared, right? I mean, this is a time when the tax code reflected a belief that those who benefited most from the system had a responsibility to contribute more to it. This idea that rich people should just pay less taxes, there's once again, and that somehow is going to help everybody else. There's no data that backs that up, no historical precedent that backs that up. When we cut taxes at the top and starve revenue, That's not just numbers on a spreadsheet, okay? That's school funding, clean water infrastructure, mental health programs, right? It's what holds our community together. You know, we're all divisive. We're all blaming one side or the other, whatever. It is a much bigger problem, okay? It's a top versus bottom. It's not a left versus right thing. This is one of the terrible, terrible things I've seen happen, is that people are so brainwashed to believe that the other political party is causing all the problems. Illegal immigrants are not causing the problems, guys. I'm just going to be honest with you. There's no illegal immigrants contribute 3% of total GDP. Okay? If you just look at the numbers, that is not what's going to solve wealth inequality. Okay? You might feel better, you might feel angry, especially people on the right who think that illegal immigrants, I mean, we can talk about, this is a whole nother ball of wax, right? Like, the true illegal immigrants are America. Americans are legal. I mean, this land is First Nations, guys. We came into this land, we stole it from the American Indians, right? Technically, we should be illegal, but now we're the arbiters of what's illegal, what's not illegal. It's just an absurd argument. I mean, if you really want to take it to that extreme, then the original settlers should have had the highest per capita GDP of anybody, because there was only like a handful of settlers owning all this land. It's just not true, guys. We've been brainwashed to think that the illegal immigrants or Democrats or Republicans are causing all the problems. There's a very small corporatist class at the very, very top. They are instituting tax policy, instituting legal policies that pool wealth, funnel wealth up. And the rest of us, it's starting to catch on. Like, people are starting to realize what's going on, but it is eventually going to become very clear that the real change needs to come with us. We need to wisen up to what's going on. And that when the bill comes due, with the big ugly bill, and $4.5 trillion is going to get financed through debt. I mean, guys, the crazy part is the $4.5 trillion is going to be our kids, our grandkids, right? That's who's going to pay for it. This is a reflection not just of economic policy. Okay, this is a reflection of our value systems as well. If the big ugly bill does not contribute to economic growth for the middle class and the working class, at the same time, simultaneously, pulling wealth up and causing more debt on our sovereign balance sheet, then it is one of the greatest cons ever performed on the American public. This pales in comparison to TARP, which was a line of credit of $700 billion. Remember back in 2008, all the banks were freaking out or whatever, and then they used the public basically came to the rescue of many of these companies. This is a drop in the bucket compared to the big ugly bill. It's the saddest thing in the world, but I hope that people are starting to wake up to the reality. This is not going to be good for America. This is not some sort of miracle. This is a mirror, frankly, on who we are as a nation. That prosperity, we are asked, trickles down from the top to the bottom. Actually, it's the reverse. If you go back to the earlier point, right? Marginal tax rates were the highest they ever were in the 40s, 50s, and 60s. Real economic health comes from ground up. Strong communities, well-funded schools, accessible healthcare, infrastructure, right? That is what leads to overall well-being, economic well-being for the entire country. And, I just want to ask a question, right? It's a good question to ask, right? What kind of economy are we building here? And who is it for? And what would we want it to look like for our kids and our grandkids? What kind of a system do we want to leave where prosperity truly flows, not from the top down, but from the bottom up, right? Where an actual tide that kind of lifts all boats. It's a good question. I want you to think about it. The big ugly bill, it's just another manifestation of what happened in 2008 to me. Mr. and Mrs. Taxpayer, you got $700 billion line of credit. We need it. The American public didn't have a say in that. And how many people benefited from it? How many average people saw wealth inequality go down afterwards? It got worse, guys. It got worse. That was a $700 billion line of credit. This is a $4.5 trillion in debt that we're financing, that Mr. and Mrs. Taxpayer are going to finance. I'm not a pessimist, guys. I genuinely hope that President Trump actually utilizes this policy, stimulates our economy, grows our economy, and it actually helps the working middle class. There's no historical precedent for it. maybe he'll prove us all wrong. But if I'm right, and we do end up financing this massive debt, and if economic growth is once again confined to the highest tax brackets, if there's structural regime change at the Fed, unprecedented, because apparently if the Fed is an independent body, and he's able to lower interest rates because he wants to fire up the printing presses to finance this big ugly bill. Guys, if none of this results in actual tangible benefits to the middle and working classes, this is one of the greatest robberies ever perpetuated on the American public. And unfortunately, the vast majority of Americans have no idea that this is about to happen. Many of them voted for this. And unfortunately, all of us have to suffer. Like I said, I hope I'm wrong. I will publicly come out with an apology. If, years from now, we're looking at 5, 6, 7% GDP growth rates, I will publicly come out here and I'll say, I was wrong. Time will tell, I suppose. But for the moment, let this be a moment of reflection for all of us. Not just about policy, but about possibility, about the kind of future we want to build, not just for markets, financial markets, but for people, like American people. Not just for growth, but for grace. Anyways, guys, that's all for now. Be good to another, be kind to another, be authentic and intentional. I'll see you next time. ConCap LLC is a registered investment advisor. Registration does not imply a certain level of skill or training. Index performance is unmanaged and provided for illustrative purposes only. It does not reflect the deduction of fees or expenses and is not directly investable. Comments concerning the past performance of monetary instruments, investment indices, or international markets are not intended to be forward-looking and should not be viewed as an indication of future results. Forward-looking statements are not guarantees of future performance and involve risks and uncertainties. Actual results may differ materially. All investments involve risk, including possible loss of principal.